This second edition was necessary to move the discussion from whether hospitality will perform.
The biggest opportunity right now with India is that when we talk about our GDP, which I just mentioned, that 50% of GDP is come from the service sector and the balance is come from the agriculture and the manufacturing.
So the good news is that India is very well insulated from global shocks.
So that's what's the power of railway-led connectivity, and the demand exists even in as small cities as like 200,000 to 400,000 population.
And what we are looking at for India as well, that when India reaches this critical milestone, there would be a similar exponential growth when it comes to the hospitality industry.
Indian hospitality is also like a purple ocean where there is an immense opportunity, but this immense opportunity is into mid-market and economic segment.
Hi, I'm Vipra and I'll be moderating today's podcast. Welcome to a conversation that sits at the intersection of India's growth story and one of the most powerful enablers, hospitality. India is not just building more hotels, it's building highways, airports, industrial corridors, ports, and an entire new travel behavior. And hospitality is riding right alongside that transformation. Think of this episode as your insider playbook. We'll unpack where demand is actually coming from, where supply is falling short, and how investors can position themselves not just to participate, but to create long-term value. Hospitality today sits at the real inflection point. Demand has returned. Capital is back, and infrastructure is expanding faster than ever before. But value creation is no longer automatic. It depends on where you invest, what you build, and how closely you align with India's evolving demand drivers. That's exactly the lens behind the second edition of our report, Unlocking Hidden Value. Before we get into the themes and opportunities, it's important to understand why this report exists and why a second edition was necessary. To set the context, I'd like to invite our senior leadership, our CEO, and our COO to share their perspective. They bring together strategy and execution, what the numbers are telling us, and what's actually happening on the ground. Joining me are Mr. Nandivandar Jain, CEO and founder, and Mr. Vijay Bhandari, COO. Can you both tell us what prompted the second edition of this report and why?
Thank you. Thanks a lot, Vipra, for setting the tone for today's podcast. When we released this first edition, hospitality was emerging from a period of disruption. At that time, the focus was on identifying opportunity, understanding where demand would return, and whether the sector would stabilize. Today, the conversation has changed. Demand has proven itself. Infrastructure investment has accelerated. Capital is actively looking for long-term thematic opportunities. This second edition was necessary to move the discussion from whether hospitality will perform to where value will actually be created, and how investors should think about participating in that growth. Why NOESIS is bringing Unlocking Hidden Value, Edition 2. My friends, before we begin today's conversation, I want to step back and answer a simple but important question. Why did NOESIS bring this report to the market, and why now? At NOESIS, we have spent over 15 years working with hotel owners, developers, vendors, operators, capital providers across India and international markets. We have lived through multiple hospitality cycles, periods of optimism, periods of stress, and moments of structural reset. What has become very clear to us over the last few years is this: the question that industry is asking today are fundamentally different from the questions it asked even 5 years ago. This is no longer a sector debating whether hotels are a viable asset class. That debate is over. I still remember my engaging conversation with one of the top equity investors in the country, and I asked him, why are you not investing in hospitality asset class or in direct stocks? His answer was to me, Mr. Jain, I'm in the business of making money, not in the business of supporting national infrastructure. I do understand the importance of this infrastructure, but my primary goal is to make money. And that was a very heartbreaking answer to receive from someone very important from the capital markets. The situation has turned today because I had a conversation with that same guy last month, and he asking me which are the best companies to invest today. The real question today are far more precise and far more consequential. Where should the capital be deployed if the hotel opens 4 or 5 years from now? Which market will still have pricing power when supply eventually catches up? Which segment will remain resilient across cycles? How should hospitality asset be structured to generate durable and long-term cash flows? Short-term volatility, these are the questions which I receive as bullets from potential investors, from the hotel owners who are looking forward to build assets. The problem is not lack of data. The real problem is lack of perspective. Most industry conversations are still dominated by backward-looking metrics. But hotels are not short duration assets. Decisions made today shape outcomes a decade from now. Unlocking hidden value, edition 2, was created to shift the conversation from hindsight to foresight, from optimism to discipline, and from growth narratives to capital strategy. This is not a promotional document. It is not a 12-month forecast. It is a framework for thinking about hospitality capital allocation in a more structured, long-term way. This report is built around 3 core ideas. The structural imbalance between demand and supply. Across India and global markets, demand has recovered faster than supply. And this imbalance is structural, not temporary. This is something very important. Investors, developers, lenders need to underwrite while doing any calculations. Connectivity now defines demand more than geography. I would like to stress on this particular point. In last year, 2025, we concluded more than 17 acquisition transactions and long-term lease transactions. One of the largest hotel transactions in the Indian hospitality industry history is the long-term lease for 30 years for 300-room hotel transaction in Mumbai at International Airport. Transaction like that few years back was something unimaginable. Today, transaction like those is gonna be a regular process for my organization. That kind of depth is available today in the Indian hospitality market. That's about airport hotel. As an organization, we completed 200-room hotel acquisition transaction at Kolkata Airport, one more very prominent airport in the country. We completed in an education city in Manipal acquisition of 140-room hotel, something very emerging. 700 crore market in the education hospitality space is waiting for you. We have acquired in spiritual destinations hotels in market like Amritsar. We have acquired hotels in commercial centers, markets like Nasik. More importantly, industrial corridors, manufacturing hubs are shaping in unimaginable manner. I have acquired 120-room hotel for one of the largest family offices in the country in market called Vitlapur, which is 70 kilometers away from Ahmedabad. There are multiple such examples which I keep going on. The important point here is hotels succeed along corridors of movement, airports, highways, railway, industry, education hubs. Segment discipline metrics more than ever is important today. Mid-scale and upper mid-scale formats continue to show strongest resilience across cycles. So why bring this report out now? Because the hospitality sector is entering early stages of a new expansion cycle. Capital is returning, financing is rational, institutions are re-engaging. Few years back, imagining a hotel debt for 20 years was unimaginable. Today it's a reality. At an interest rate of little over 8%, at a flexible moratorium periods, and above all, you have repayment also well structured today, matching to the hospitality cash flows. This has encouraged investors to come back in a full flow. And that's what tells on the basis of the kind of feasibility reports in last 2 years NOESIS is doing. Every year we are completing successfully 75 to 80 feasibility reports across the asset classes from hotels, resorts, service apartments, private clubs, golf, casino, and many other formats which are new age formats. But expansion cycles are when the most expensive mistakes are made. Hotels fail not because demand disappears, but because capital is deployed in the wrong markets at the wrong scale, with the wrong assumptions. The purpose of this report is not to predict future. It is to help investors choose the right future. It will get these directions right today. We will not just build profitable hotels, we will build enduring assets. That is how strong hospitality ecosystems are created. As an organization, it's the least duty we all sitting on this table have towards Indian hospitality industry to make sure every investment which goes in this ecosystem, if it is coming and touching our desk, has to be right. Because many of us who are active in this space are writing the glorious period of Indian hospitality sector. To make this glorious, we have to make sure that we all act and work with full responsibility. From here, I will request my friend Vijay to please take it over and give his perspective on the report.
Thank you, Nandi. Thank you, Vipra. As my colleague Nandivadar has mentioned, that we deal with a lot of investors day in, day out. Today morning, we were discussing that there are a lot of foreign investors as well as the domestic investors. They are looking for an investment opportunity in India. What is happening is right now, we are facing every day a unique situation. The situation is that there are a lot of capital and a lot of investment is available with the investor. An investor asks us the question, where to invest? Because currently in last 4 or 5 years, we have seen the upcycle of the investment in hospitality. If you look into it from 2021 to 2025, the capex in the hospitality has remained as one of the top 5 capex in the country and the nation. Now they are coming to us and asking that now where to invest from now onwards. Because what is happening in the Indian economy that every minute, every hour, and every day, the Indian economy is changing. And every tomorrow is better than today. In last 11 years, from 2014, the Indian economy, the Indian social sector, the Indian politics has seen major reforms. And all these reforms, what it brings to us is that today the GDP of our country is $4.15 trillion. We are the 4th largest economy in the world. The best part of this GDP growth is that we achieved our first GDP in 2007, the first $1 trillion. The second $1 trillion we achieved in 2014 and 15. The third $1 trillion we achieved in 21-22. And then the $4 trillion we achieved in shortest of 12 to 18 months time. Now, Indian economy has come to an inflation point where every year or every 15 to 18 months, we are adding a new trillion to our economy. Today, travel and tourism has contribute around 8 to 10% to the GDP. And most of the forecast is there by 2047, 15th of August, when we complete 100 years of Indian independence, our GDP will be around $14 trillion. Imagine a $14 trillion GDP 2 decades down the line, out of which the 10% of GDP is coming from travel and tourism. $4 trillion of GDP 2 decades down the line. You can imagine the kind of opportunity we will have in that time. Second, currently the per capita of income of India, we are at 2,800 USD. And we are anticipating by 2030, the per capita income will be 4,400. And this is the inflection time for the Indian economy. And we have seen the similar kind of inflation in US in 1960. And we have seen the similar kind of inflation in China between the period of 2006 to 2010, where the per capita income was between 3 to 5,000. And they have seen a major boom in consumption, and at the same time they've seen the major boom in the travel. So we are anticipating that as the per capita income of India increase, and it will be twofold by 2030, we're going to see a 2x travel boom in the Indian economy. When we talk about Indian human asset and Indian population, today we are one of the largest population in the world. We represent 1.46 billion, and we represent 18% of the world population. Out of every 8 people in the world, 2 are Indians. And the best part of our population is that 70% of population are millennial and Gen Z. So you can imagine what kind of opportunity we are sitting at. We talk about the disposable income. Currently, we have a disposable income of $3.5 trillion. And by 2030, we are anticipating the disposable income will go up to $6 trillion. In our second edition of Unlocking and the Hidden Value, what we are unlocking is that there are a lot of immense investment opportunities available with the infrastructure development in the country. We are talking about airports. We are currently have 160 airports operational, and another 240 by 2030. We are anticipating there will be a 250 or 240 airports will be there. So there are a lot of opportunities available in the airport segment. Most of our Indian airlines, they have ordered combinedly around 1,500 aircrafts. Every year, we are anticipating that Indian Sky will add minimum 100 to 200 aircrafts, and there will a lot of new routes will be open. So there are a lot of immense opportunities available for investment if you are looking at airport lead development. When we talk about road, today we have one of the world's largest road network. Today the road network is 6 million kilometer, out of which half of our road network is on national highway and the state highway. There's a lot of immense opportunity, or you can say $1 billion opportunity to invest in the motels. Then we talk about the port. Government has now a special emphasis on developing the blue economy. What is a blue economy? From long time, we were not utilizing our ports for our logistics. There are only few ports which are operational. Now what government is doing is that they are investing 8.5 lakh crore in development of multiple ports. And you will see that our ports will be a next growth opportunity for Indian hospitality. Then we'll come to the railway. Today we have around 7,500 railway stations. Some of them are modernized, some are undergoing the modernization, and government has also announced there will be new 500 railway station will be built. Every month we see that at least 2 or 3 new Vande Bharat is coming up. So there are a lot of opportunity which lead to the railway station lead development. One of the biggest opportunity right now with India is that when we talk about our GDP, which I just mentioned, that 50% of GDP is come from the service sector, and the balances come from the agriculture and the manufacturing. Now the government has a lot of emphasis on manufacturing, Make in India. And in the Make in India opportunity, there are a lot of investment is going in developing the industrial hubs, and a lot of investment is going in the logistic park. So this industrial hub and the logistic park is also offering a lot of opportunity to develop industrial lead hospitality or industrial hotel. So in this addition, we are unlocking a lot of new investment opportunity, and those investment opportunities are currently hidden. And my colleagues who are sitting and left to me and right to me, they're going to take you through this investment opportunity.
Thank you, Mr. Vijay and Mr. Nandivardhan, for sharing those valuable insights. What stands out from both perspectives is that hospitality today is no longer about recovery. It's about alignment. Alignment between demand and connectivity, between infrastructure and format, and between capital and execution. With that foundation in place, let's zoom out and step back a bit. Every strong investment thesis begins with a macro view, understanding how global hospitality is evolving and where India comes into the picture. I'd like to welcome Jay to come and share his valuable insights. Every valuable investment opportunity needs a macro lens. Global hospitality has entered a phase of disciplined growth, demand has stabilized, and high utilization levels where supply expansion has slowed. India, however, stands out not just because it's growing, but because it is structurally undersupplied. Jay, take us through the global hospitality and Indian overview.
Thank you, Vipra. So first, when we talk about the global tourism, first I want to draw people's attention towards the number of foreign tourist arrivals around the globe. Since the COVID pandemic ended, everyone has been wondering when this number will finally cross the pre-pandemic level. And I'm happy to say that last year it finally happened. The number was 4% higher than what it was in 2019. This was largely due to the massive increase from 2024 to 2025. If you just look at the first half of 2025, a total of 690 million people traveled around the globe, which was a 33 million year-over-year increase from the previous year. And it's not just how many people are traveling, it's also how much money they are spending on tourism. Just last year, this number exceeded 1.6 trillion US dollars. If we look at some of the top markets around the globe, these are still your traditional markets that everyone expects. France at 100 million, Spain with over 90 million, and the US with over 70 million tourists. That being said, it is important to note that most of the growth that has happened over the last half decade has happened in the Asia Pacific region.
In your opinion, why has the frequency of travel increased over the last few years?
So there are two main reasons. The first and the most obvious one is the improvement to infrastructures. We have seen new airports come up around the globe. The travel and the road infrastructure has also improved. This has massively improved both the international as well as domestic connectivity. The second reason, and perhaps the most important, is the growth in middle-income households in the Asia-Pacific region. At the beginning of this century, there were 500 million people in this income category. This grew by 4 times by 2020, reaching 2 billion people. By 2030, this number is expected to reach 3.5 billion, a 7x increase from where it was at the beginning of this century. Now, obviously, as middle-income households increase in number, it leads to an increase in disposable income, which naturally causes a rise in demand for travel and tourism. It is also important to note that the supply of hotel rooms has not been able to keep up with this increase in demand, as it has only increased by 0.7% year on year over the last 5 years. This has caused a massive gap between hotel room supply and hotel room demand in various markets across the globe.
Jay, can you tell us more about the Indian market and the trends over the last couple of years, along with the future projections, as well as how people are traveling?
Sure, let me first talk about how Indians are choosing to travel. I think everyone on this table is already familiar with the Udan Yojana. There are 160 airports across the country, which has massively improved the air connectivity. Despite that, only 5% tourists are choosing to travel via air. Roads still dominate travel within India, with more than 80% Indian tourists choosing to travel via roads. Railway also remains an important mode of transportation. Just last year in 2025, nearly 8 billion people chose to travel via Indian railways, which is nearly as much as the world's whole population. Now, talking about the hotel industry in India specifically, in 2025, it was valued at over 24 billion US dollars. This number is expected to exceed 45 billion by 2030. Talking about the performance of hotels in the Indian market, last year they achieved an occupancy of 68% at an ARR of 8,500, which resulted into a RevPAR of 5,750. Now, talking about some of the top markets in India in terms of occupancy, it's still dominated by your metro cities. Mumbai at 79%, NCR not far behind at 78%, and Hyderabad at an impressive 75%. But when you take a look at the ARR, it tells a different story. Udaipur was king when it came to 2025, with an ARR of over 15,000, driven by luxury properties in the market, as well as a very strong wedding demand across India, especially in Udaipur. Now, as I mentioned earlier, there's a huge gap between supply and demand in the Indian market. It has not gone completely unnoticed. As of right now, there are 196,000 branded rooms in India. This is expected to increase by 38% by 2029, despite which there will still remain a huge gap in the market. Currently, there is only one room per 7,000 plus Indians. By 2029, even with the addition of all those rooms, it will still remain at just one room per 4,800 Indians.
Jay, could you tell me how has this affected the Indian economy and what markets or what sort of markets have benefited from this?
So first, talking about travel and tourism's contribution towards Indian GDP, when we take into account both the direct and indirect contribution, it has increased substantially over the last decade. It has gone from 170 billion to 250 billion just over the last decade, and this is expected to cross 300 billion by 2030. Now, when we talk about markets that have benefited the most from this growth, even though we saw that metros are still dominating in terms of occupancy, markets that have benefited the most are your tier 2, tier 3 cities, as well as your pilgrimage destinations.
Hi Jay, so how important is the domestic travel in insulating from the global shift right now?
So the good news is that India is very well insulated from global shocks. Out of all the Indians that are choosing to travel, over 90% of the people are choosing to travel within the country. Even when you look at their total spend, more than 70% of the amount that they are spending on travel and tourism is being spent in the country itself.
Thank you, Jay. That macro context is critical for understanding where the real gaps and opportunities lie. However, demand does not grow in isolation. It follows access. A central argument of this report is that hospitality growth in India is being unlocked by connectivity. Let's begin with the fastest and the most transformative of these, air connectivity. Air connectivity does more than shorten distances. It changes how people travel, how spontaneously they make trips, and how viable short stays have become. Harsh, help us understand what expanding air connectivity is in relation to hospitality demand.
The history of hospitality dates back to when travelers sought accommodation when they were traveling. Fast forward to today, air travelers have risen in numbers, and so air transportation has become the fastest and the most used medium of transportation all around the world. Inevitably, there is a direct relationship between hospitality and airline industry, and they have a really deeply rooted connection. So a rise in air travel will lead to a rise in hospitality demand. There are currently 160 operational airports in India, where we can say that since the launch of Udan scheme in 2017, new 6 airports have been developed each year. The tourism receipts in India have increased by $13 billion. Currently, India has 5 major airports, namely Mumbai, Delhi, Bangalore, Chennai, and Hyderabad, with a total combined capacity of 230 million passengers, which is 60% of the total passenger traffic in 2024. There are upcoming airports in India, such as Jewar, which is said to be the largest airport in Asia once it is fully operational, Navi Mumbai Airport, and Purandar Airport in Maharashtra, Pune. It is worth noting that India has such a strategic location that over 60% of the population is within 5 to 6 hour radius, and as well as India is developing as well.
So what are the changes we are able to see in case of domestic demand drivers?
So one of the fastest growing market in India is the pilgrimage and the wellness market. Piyush will help us understand this in the later segment of this podcast. However, I will answer this from a perspective of air connectivity. Let's take an example of what Ayodhya did. Since the inauguration of the new airport in 2023 and in 2024 the construction of Ram Mandir, it had a huge influx of passengers. In 2024, it attracted 11 lakh passengers just via air and 20 crore plus visits in total because of real estate infrastructure as well as religious constructions that are happening in the region. So such emerging markets are coming in India, such as Puri, Sabarimala, Rameshwaram, and many more. So these have the potential to replicate the same model because these regions already have a historical and significant importance religion. So this model can be replicated for them as well.
So, how is the development of aerocities near the airport crucial for hotel development?
So aerocities in simpler terms are cities within cities which have closer proximity to the airports. These are self-sustaining cities, or what we call as an ecosystem. They are vibrant, they have lifestyle features as well, modern amenities and lot of infrastructural developments as well. Currently there are 11 major aerocities coming up in India with high modern infrastructure, lots of development and many investments are going around in these regions as well. Currently, the Hyderabad aerocity is said to be the largest aerocity in India, spanning over 1,500 acres of land. Today, many big giants of this industry are eyeing to build hotels in these markets because they are underserved. So, it is the right opportunity to invest at the right time before it is too late.
Thank you all for sharing your valuable inputs on this sensitive yet very important topic. What's striking here is that airports are no longer just gateways, they're anchors. Wherever air connectivity improves, we see entirely new travel patterns emerge and hospitality demand follows much faster than it ever did before. Air connectivity reshapes how frequently people travel and how far they're willing to go. But once we're in the system, it's railways that move India at scale. Rails remain the most democratic form of mobility in the country, touching metros, industrial hubs, pilgrimage towns, and emerging cities alike. Rishabh, help us understand how railway modernization is quietly becoming one of the strongest hospitality demand engines in India.
Today, I'll be discussing one of India's most compelling yet underexplored hospitality investment markets, station-led hotel development driven by railway optimization.
So Rishabh, why is the station-led development a bigger opportunity in this market at this point?
Station-led hotel development works today because of three structural shifts that are happening together. Travel behavior is changing. Faster and more reliable trains increase trip frequency and reduce booking lead times. Convenience now dominates decision making, and which directly benefits hotels which are located close to these stations. Demand around stations is no longer single purpose. Stations today serve business travelers, consultants, pilgrims, leisure tourists, and transit passengers simultaneously. This multi-segment convergence is the foundation of stable hotel occupancy. Third, stations are becoming commercial ecosystems with private-public partnerships led redevelopment that's integrating retail, offices, parking, and mixed-use assets. Stations now generate permanent footfall, not just because of passenger movement. A global example is the Shibuya station in Tokyo. It's not just a railway station, it's a fully integrated urban district with departmental stores, malls, hotels, entertainment hubs, offices, and transit interchange, all layered in a single ecosystem. The station carries millions of passengers daily, but the surrounding ecosystem, the commercial ecosystem that's created, ensures footfall that converts into sustained economic activity. Station redevelopment vision is moving in the same direction. As Indian stations evolve to similar transit-oriented commercial hubs, hotels located within these ecosystems benefit from guaranteed visibility, constant demand, and long-term real estate appreciation.
Thank you very much for this informative download, Rishabh. Now, for all those who are thinking to develop hotel close to station, which all locations would you say are the most promising?
Thanks, Piyush. When I evaluate station-led opportunities, I prioritized on three factors: passenger volume and connectivity, demand diversity, and branded hotel supply gap. Based on these factors, several Tier 2 and emerging cities stand out. Meerut is emerging as a high-frequency commuter city and a business extension of NCR region. Its connectivity to Delhi by the Delhi-Meerut RRTS corridor, and also the station redevelopment under Amrit Bharat scheme is transforming its connectivity. The demand profile of Meerut is influenced by the daily business commuting and the corporate commuting to the NCR region. Next is the Mumbai-Ahmedabad bullet train. corridor, which will create a completely new category of station-led hotel markets. Vapi will benefit from the industrial and chemical manufacturing units that are there here. Surat will see an accelerated and short stay corporate demand, and also from the diamond and textile trading that happens here. Next, Ahmedabad will strengthen its position as a corporate and financial center, especially with GIFT City's rapid development. This corridor will not just reduce travel time, it will redefine how business travel is redistributed across the western corridor. Next, Alwar functions as an industrial decentralization of the NCR region with its small and medium manufacturing units and also automobile manufacturing. This is becoming another extension of the NCR region, with the rail connectivity improving due to the Delhi Alwar RRTS corridor and also regional rail upgrades. The demand here will boost due to the manufacturing sector, and this will create a strong case for mid-scale hotels to develop in this particular region. Next, coming to pilgrim and religious places, Bodh Gaya is one of India's most important international pilgrimage destinations. This is due to the Buddhist monuments and temples located in this particular region. Connectivity is facilitated through the Bharat Gaurav services and also the upcoming station redevelopment coming under the Amrit Bharat scheme. Demand is anchored by the international Buddhist pilgrimage demand and also leisure tourism. Hotels here benefit from high seasonal peaks and are supported by strong year-round religious travel. Next, Ayodhya represents one of the fastest growing religious tourism markets in India, with the station redevelopment program under the Amrit Bharat scheme and also high frequency religious purpose trains running over here. There's been an explosion of pilgrimage tourism in this market since the opening of the Ayodhya temple. This supports high free occupancy pilgrimage and transit oriented hotel formats. What these cities demonstrate is that railway modernization is no longer just about improving connectivity, it's redistributing hospitality demand across India.
Rishabh, great insights. Your whole talk made me remember one interesting incident which happened with us. I think story of 2017 or 18. I was sitting in an office. I received a call from chairman of Suba Group. They recently went public and it's a listed company now. So the chairman, Mr. Mansoor Mehta, dear friend, he called me and said that, Nandi, I'm planning to bid for 2 lands in Gujarat, one in Junagadh and one in Bhuj. And one, RLDA, Railway Land Development Authority, opened the bid for land acquisition to build the hotels, and it was refined that it has to be hotel development. So he called me and said that I have a gut feeling the hotel will work. And my immediate reaction, these are tier 4 cities, population less than 4 lakh, and in one case it's less than even 2.5 lakh. Are you sure you want to even appoint us to conduct a detailed feasibility report, because it's a cost? He said, I am convinced. And I have a lot of respect for that man because he's a man of the ground. He runs a logistic company, transport company, and he understands the markets very well and with some extreme entrepreneurial mind. So I asked him consciously that, are you sure you really want to invest in even getting the feasibility study done? He said, my business sense says that it's gonna be great, but there's no president here. It's making me difficult to convince my own team. So I want you to come up with your own individual view with scientific data and present to us whether we should be going ahead with this or not. Our feasibility team invested good 45 days because there was no historical data. We have to take reference market approach. And you will be surprised, the demand drivers were very strong for these markets. Junagadh, because it was close to one pilgrim center, like 10 kilometers away, it was Jain Pilgrim Center, Girnarchi, yeah. And sectors like FMCG, telecom, banking and finance, insurance was getting full support along with pharma companies. So all the sales guys used to struggle to get a good accommodation. When we did a detailed analysis, we found that there is enough demand, and they finally took both the sides, built, I think, 50 to 60 room hotels. And today, those assets are yielding them IRRs of anything around 17 to 18% comfortably. Okay, that's the power of railway connected hotel infrastructure. And the smart thing they did, they even expanded further the F&B option in that with the banqueting space. So the locals get good organized inventory with the banqueting support function, along with the transit guys who are going to use the accommodation. And so, because they started Click in Junagadh, that created certain floor level for the ADR and occupancy. After that, Sarovar came up with the upscale product. Fern came up with the upscale product. And all of them are performing reasonably well, considering it's a city of 400,000 people only, urban population. And similarly, Bhuj has done phenomenally well. So the numbers of, if I say Regenta in leisure market is one of Royal Orchid, Regenta with a brand called Regenta, it's operational there. Click entered there, they created a floor value again. They entered but with the economy product, and it encouraged other hotel companies to enter those markets. So that's what's the power of railway-led connectivity, and the demand exists even in as small cities as like 200,000 to 400,000 population.
2022, we got an opportunity to do an acquisition sale transaction for a 100 keys hotel just outside Vadodara station. The moment this opportunity came to us and we connected to our sources, and everybody was very much interested. We were successfully able to close the transaction within 6 months. You can understand the urgency of the investors that were actually eyeing these markets. And ultimately, it went to OYO Group, and they branded it as a Sunday hotel, which is not a mid-scale hotel, but an upscale brand. And now that hotel is performing phenomenally well. So the data speaks for itself that how these railway networks are boosting not only the infrastructure, but overall development of the region as well.
Thank you, Mr. Nandivardhan and Mr. Piyush, for sharing these interesting stories. And finally, thank you, Rishabh. That was a very clear view of how rail infrastructure is quietly redistributing hospitality demand. If railways redistribute demand across cities, roads do something equally powerful. They multiply it. Road infrastructure changes travel patterns at scale. It enables weekend tourism, intercity travel, logistics movement, often all at once. Tanmay, take us through how India's highway network expansion is creating one of the largest untapped hospitality opportunities in the country. Can you also emphasize a little bit more on why roads are so critical in the country's economy in this day and age?
For sure. Roads are the backbone of India's transportation system. India today operates one of the largest road networks in the world, spanning approximately 6.62 million kilometers. What makes this especially significant is the degree of lands that it has. 85% of the passenger movement and 70% of the freight movement in the country takes place via the road network. Despite investments in railways, ports and aviation, roads still remain the primary enabler of everyday travel, trade, tourism and logistics. In practical terms, highways are not peripheral infrastructure, they are central to how India operates fundamentally.
Okay, so Tanmay, what level of public investment is being supported in this expansion? Could you tell us a little more about this as well?
Thank you, Satyajit, for asking that question. This expansion has been backed by sustained and rising public investment. Highway spending reached roughly around a record 2.5 lakh crore in FY25, with budgetary allocations remaining elevated in subsequent years as well. Nearly 1,900 major road projects were currently under execution nationwide, many structured under the PPP model. This reflects a long-term policy commitment rather than a cyclical or one-off infrastructure spending.
So what does the future highway pipeline look like?
So Nikhil, the future pipeline remains highly ambitious. In September 2025, the government announced a 11 lakh crore investment to construct 17,000 kilometers of new expressways by 2033, with roughly 40% already being under construction. Additionally, another 27 greenfield express corridors spanning nearly 10,000 kilometers have already been identified. Capacity upgrades are also underway. 25,000 kilometers of 2-lane highways are planned for conversion to 4-lane, and another 16,000 kilometers of 4-lane highways are now being expanded to 6-lane highways. More than 20,000 kilometers of projects have already been awarded under the Bharatmala Pariyojana, ensuring sustained corridor-level traffic growth for years to come.
Thanks, Tanmay. To build upon my previous question, has lodging infrastructure along highways kept pace with this expansion?
So, if I could put it in a nutshell, it's no. And this is one of the most visible gaps in India's highway ecosystem. India currently has approximately 2,000 branded hotels with almost 2 lakh room nights. And the majority of this supply is concentrated in metros or established tourist destinations. Along long corridors such as Mumbai-Delhi or the NH44, travelers often drive several hundred kilometers without any organized accommodation. Highways remain dominated by fuel stations and dhabas with very limited purpose-built motel inventory.
Tell me one thing, these highway motels that you mentioned, how they realistically affect the overall ecosystem?
Thank you, Jeff. So, highway motels are inherently multi-demand, multi-revenue assets, not just limited to overnight stays. A well-conceived highway motel typically includes clean, efficiently designed rooms with ample surface parking for cars, buses, trains. It also provides for quick service and regional food offerings with EV parking as well, tucker dormitories and hygienic facilities for them. Basic business amenities such as small meeting rooms or co-working pods and ancillary spaces for convenience retail or micro logistics are also something that need to be taken into consideration. This amenity mix allows us to understand the motels do not serve just the leisure market, but they also provide us with freight movement, EV users, business transit. So the business perspective is quite larger than, let's say, city center hotels or destination hotels.
Okay, so Tanmay, can you tell me what is the typical cost of per key construction for a motel project?
Of course, sir. So because the product is standardized and efficient driven, rather than a luxury oriented hotel, the development cost remains relatively contained. In a conservative motel, a 50 key highway motel built at a 20 lakh per key has a development cost of approximately 10 crore. This is marginally lower than urban or destination resorts and enable faster scalability, predictable capital deployment, and resilience across cycles, especially when supported by diversified revenue streams.
Tanmay, how large is the market for motel hotels, segment category I'm talking, in the country at this point of time?
So, sir, for a market sizing perspective, the opportunity is quite substantial. When we consider national highways, expressways, and key state highways, the addressable road network extends to roughly 3.25 lakh kilometers. If we take one hotel every 300 kilometers, the total addressable market is approximately 1,000 hotels. This translates into roughly 55,000 room nights. At 10 crore per hotel, this represents a total addressable development value of 10,000 crore.
Highways clearly aren't just about faster movement anymore. They're becoming economic ecosystems in their own right, and hospitality along these corridors is no longer a niche, it's a scale opportunity. So far, we've looked at how India moves within itself. But some of the most resilient hotel demand comes from where India connects to the world. Ports are not tourism assets first, they are economic infrastructure. Under Sagarmala coastal regions are being anchored into India's growth story. Prithvi Shankar, help us understand how Sagarmala plays a powerful tool in hospitality.
Thanks, Vipra. So, the Sagamala program is injecting close to 5.8 lakh crore in cruise logistics and port constructions in India. Wherever ports scale up, that's where all the discretionary and non-discretionary hotel demand comes. From shipping lines, port authorities, EPC contractors, consultants, auditors, and logistical firms. Unlike leisure destinations, this demand is year-round, weekday heavy, and resilient to economic cycles. hotels become secondary infrastructure similar to how business hotels follow airports and industrial corridors. For investors, this means predictable occupancies before a destination narrative even exists.
How exactly does this infrastructure translate into hotel room demand in real terms?
Demand comes in layers. The base layer is industrial and corporate, port operations, crew managers, inspectors, auditors, compliance, and vendor visits. On top of that, Sagarmala is adding cruise terminals as well, which brings the pre and post cruise stays. India saw 4 lakh cruise passengers in FY 2024 only, with international cruise arrivals growing over 300% year on year. Even if only half of those international passengers stay one additional night, that can translate into 49,000 incremental room nights annually. If you look at it from a big picture perspective, that's 40 to 50 crore of direct hotel revenue at mid-scale rates. Importantly, this demand emerges before the leisure tourism even matures, giving hotel investors a long runway of stable cash flows and can be a part of the entire market's maturity evolution.
So what is the right hotel strategy for the investors entering these markets, and what should they avoid?
The winning strategy is mid-scale business hotels, typically 80 to 150 rooms, an ADR of 3,500 to 6,000, efficient construction, limited but strong F&B and extended stay friendly rooms. These assets stabilize quickly and align with the core demand profile of the port cities. What investors should avoid is leading with luxury or large resorts assumptions too early. Early stage port markets are functional, not aspirational. Resorts work only after the ecosystem is mature. So the key investors takeaway is very simple. Sagarmala ports represent hospitality arbitrage. Infrastructure is built first, hotels always follow. And those who enter early with the right product enjoy years of stable annuity-like returns before competition even arrives.
So Prithvi, there's a real proof that port-led market works? And are we saying this is still theoretical, or you have some example of past markets?
Yes, there is a strong historical proof. Let's look at Kandla Port in Gujarat, which began operations in 1950s. But the first international branded hotel only opened in 2012. That's a 57-year lag before any branded hotel came. Today, branded hotels there operate at 65 to 75% occupancy year-round, driven almost entirely by the port and industrial demand. Second example, Mundra Port. It shows the same pattern with a shorter lag. The port started in 1998 and the first branded hotel opened in 2015. That's a 17-year lag, with current occupancies ranging from 75% to 85%, often sold out on weekdays. The consistent lesson for the investors is that hotels always come late, but the first organized hotels captured the dominant market share and command the rates and hold the long-term pricing power.
Prithvi, so which port markets are already mature as per statistics, and where you see the real opportunity for the investors?
I'm glad you asked. Markets like Mumbai and Goa are largely mature and the hotel supply is already there, high land costs, heavy competition and compressed returns. Cochin is another example of a semi-mature with boutique and heritage-led growth, but they also have a large port coming. But the real opportunity lies in underserved and emerging ports such as the Ennore in north of Tamil Nadu, Vizag and New Mangalore, where the port and cruise activity is rising but organized hotel supply remains limited. Even more compelling, and what I suggest our clients, are greenfield Sagarmala ports like Vadhavan, Vizhinjam, Durgapatnam, Dajpur in West Bengal and Andhra Pradesh port clusters. These locations currently lack a structured hospitality ecosystem. There is land waiting to be grabbed and not all players have got their eye on it yet, which is precisely why investors should be securing land and planning assets now, not when the demand is obvious and the pricing has gone up. The first ones to start digging will be the first to find the treasure.
Thank you, Prithvi. What really stands out is how port-led demand flips the traditional hospitality playbook. Here, demand comes first, Tourism narratives follow later, which is exactly why early movers tend to hold pricing power for so long. Connectivity creates demand, but demand only becomes value when it's served thoughtfully, efficiently, and at scale. That's where investment strategy comes in. Let's now look at how infrastructure-led growth is translating into concrete, repeatable investment opportunities. Industrial hubs may not always sound glamorous, but for investors, they offer something incredibly valuable, which is predictability. Predictable demand, longer stays, and structurally supported growth. Rishabh, walk us through why manufacturing hubs are the next milestone for hospitality growth.
Thanks, Uttara. Today I'll outline why manufacturing and logistics hubs across India are structurally emerging as the next frontier for hospitality investment. India's hotel demand is no longer driven only by metros and leisure destinations. It's increasingly anchoring towards industrial parks, logistics expansion, and infra-led investments. This transition is creating a new class of hospitality markets characterized by higher stability, longer stays, and predictable demand patterns.
So how are these industrial corridors initiatives translating into hotel demand?
Glad to answer that, Nikhil. India's National Industrial Corridor Development Program, or the NICDP, represents one of the largest manufacturing infra-led initiatives globally. Its objective is to develop globally competitive industrial ecosystems supported by multimodal transport, logistics infra, and planned urban development. Under this program, 11 national industrial corridors are under development with a total investment capital planned of 15 lakh crores. Let that sink into your mind. 15 lakh crores. To contextualize, the DMIC, or the Delhi-Mumbai Industrial Corridor, alone has planned investments of about 8 lakh crores. The Chennai-Bangalore Industrial Corridor is backed by investments of about 2 lakh crores. And the Amritsar-Kolkata Industrial Corridor targets investments exceeding 16,000 crores. In addition, up to 20 greenfield industrial smart cities are planned across these corridors to attract global manufacturing, electronics, defense, engineering, and logistics investments. From a hospitality perspective, each corridor generates structural, recurring, and diversified hotel demand. The parallel development of logistics hubs further strengthens the ecosystem by enabling 3PL logistics, warehousing, and freight operations, which in turn produces stable short stay and rotation-based hotel demand. In summary, industrial corridors create hospitality markets that are policy-backed, infra-supported, and economically anchored. I evaluated micro markets using 3 primary filters: industrial or freight corridor access, industrial sectors, and the logistics connectivity. Based on these parameters, several manufacturing and logistics hubs stand out. Starting with the manufacturing hubs, the largest upcoming manufacturing hub in India, Dholera Special Investment Region in Gujarat, is a part of the DMIC corridor, with sectors such as semiconductors, aerospace and defense, and green energy emerging. Tata Electronics and PSMC, for example, is a joint venture with a collaborative investment of about $12 billion. And the total investment in this particular manufacturing hub is about 3 lakh crores. The second is Shendra Bidkin Industrial Area, or AURIC, in Aurangabad. This Aurangabad has always been dominant with automobiles and textile companies. And the planned investment in Aurangabad is about 71,000 crores. Even other manufacturing hubs such as IMC Hisar, Ponera node in Tamil Nadu, Zahirabad Industrial Area in Telangana, and Krishnapatnam Industrial Area in Andhra Pradesh have planned investments of thousands of crores, all about 10,000 crores in the range. Next, moving on to logistics hubs, the largest port in India, as Prithvi mentioned earlier, the Vadhavan port has got approval of project cost of 76,000 crores and will be operated by the Adani Ports and a Swiss company called Terminal Investments. Second is the multi-modal logistics hub in Dadri, Uttar Pradesh, which will be operated by the NICDC with a project cost of 7,000 crores. Next is the Dighi Port Industrial Area in Maharashtra, a part of the Western Freight Corridor. And finally, the integrated multi-modal logistics hub in Nangal Chaudhary, Haryana, under the DMIC, This will be operated by the NICDC. These locations combine industrial production with rail and road freight integration, making them highly suitable for business-focused hotel development.
Thank you for those valuable insights, Rishabh.
Rishabh, I totally echo with what you were saying on manufacturing and logistic hubs. In last few quarters, we have done multiple transactions. So we acquired a 120-room hotel in Vitlapur, which is an automobile manufacturing hub in Gujarat. We did in the same market signing of a 150-room Hyatt Place in Vitlapur again. So some of the smart investors are moving. I must say that Courtyard by Marriott in Chakan is a fantastic case study. The investor moved at a very early stage. They identified that market. Recently in Talegaon manufacturing hub, we have signed the Fern Cities by Marriott product over there. And across the country, as per best of my memory, I think more than 20 plus hotels in some form, either acquisitions or management or leases, the transaction team has signed. So the smart investors are actually already having eyes on it. But the kind of depth you have provided today in terms of the number of new markets which you have just mentioned, DIMC and the other corridors, that is something really eye-opener for a lot of investors sitting and hearing you today. Great job.
Thank you, Mr. Nandit. The pleasure is all mine.
Just to add what Nadi said, the government of India is working very hard day and night to increase the investment in Make in India and increasing the manufacturing hub. Today, the 14% of our manufacturing cost is logistic, and government is trying to reduce and bring it to 10%. So government will be investing more and more in the infrastructure, and at the same time will be opening more and more industrial hubs.
Yeah, well said. That's a very good point on supply chain formations.
Hospitality formats are also evolving alongside lifestyle and work patterns. One of the most interesting shifts we're seeing is the blurring line between hotels, housing, and long-term accommodation. Let's talk about co-living hotels, not as a residential concept, but as a new hospitality asset class. Janvi, can you tell us about who is driving this demand and why this model makes sense now?
Absolutely. So this model fits exactly how the Gen Z and the millennials live and work today. So most of them do not want these long-term leases, hefty upfront deposits, or an entire apartment where they have to furnish it. So we want flexibility, convenience, and a built-in community. And especially if you're moving cities for work, building career, in data, technology, or even working remote for that matter. And co-living hotels beautifully solve all these problems. So you can check in on the same day. Everything is included, like Wi-Fi, security, utilities, community activities. And for all of this, you just pay one single price. So all of this started back in COVID when the rent reached very skyrocket in the urban cities, like around 30 to 50,000, and a co-living hotel priced between 25 to 50,000, all inclusive of these amenities, started looking very attractive. So when you look out at the industry reports from Colliers or even PropTiger, you consistently see that co-living occupancies have crossed 75 to 80% always. So yes, this is another new sector which is quite booming.
Janvi, thank you. Very well said about the co-living. But there's a lot of confusion about this word co-living. Can you tell us exactly what is co-living hotels?
That is very true actually. So when people hear co-living, they immediately think of PGs, shared apartments, or just a bunch of people splitting rents altogether. So this is a completely different category. These are not hostels and definitely not the residential PG setups. So these co-living hotels operate under proper hotel licenses. They offer fully furnished private rooms, and they come with amenities that you could expect out of a modern hospitality product. Like think of lounges, co-working spaces, fitness rooms, high-speed Wi-Fi, digital access systems, and curated community events. So you get the privacy of your own room and the flexibility of staying in as long and as you want. So there are these platforms like Zolo, Stanza Living, Settle, and CoHome that have already proven the demand for flexible living exists out in India. Even Oyo Life had tested an early version of this model. So definitely yes, the next evolution in the hotel grade is co-living.
So Janvi, can you elaborate what does the investment opportunity look for in co-living hotels?
So co-living hotels are emerging as a very serious asset class in hospitality sector. So the revenue out here is very predictable because you have monthly pricing. Operating expenses are quite lower than those of the traditional hotels because you do not need full F&B or banquet operations. And on top of the room revenue, there are other strong additional income sources like those of premium upgrades, co-working passes, F&B outlets, laundry, events and workshops. So EBITDA margins remain very high and competitive. The landscape is still very wide open because we still do not have one single national co-living hotel brand yet. So existing players mostly operate like an upgraded version of PG, and only few operators, which I would like to name like the Hive, Olive, Hello World and Grexter, are inching more towards hotel grade formats. So this brings a huge opportunity for the institutional investors to build their first scalable branded co-living hotel portfolio across the major metro cities like Bangalore, Mumbai, Hyderabad, Gurgaon, Chennai, Delhi.
Janvi, why do you believe co-living hotels will be one of the next major growth stories in India?
So because this model perfectly aligns with the lifestyle of the young India, so we are a country where the 70% of the population is under 40, as rightly said by Vijay sir, and the entire demographic is choosing flexibility over ownership, community over isolation, and curated experience over the basic accommodation patterns. So when you combine that with urban mobility, rising rental costs, remote working culture, and a massive tech force. So co-living hotels sit right at the intersection of the hospitality, housing, and modern work. So they are not a compromise between hotel and apartment. They are an evolved category in themselves itself. So this is a huge opportunity for the investors, operators, and even the consumers. This space is just beginning to unlock its full potential.
Thank you, Janvi. That was very beautifully said. What makes co-living especially compelling is how it reflects on hospitality adapting to lifestyle change, not fighting it. This isn't about a compromise format. It's about how a younger India should respond to lives and work. One of the most powerful demand creators within the industrial and commercial ecosystem today is the rise of global capability centers. Global Capability Centers, aka GCCs, bring together high-frequency repeat corporate travel into very specific micro-markets. Siddesh, let's start with the big picture. What exactly are GCCs and how do they relate in hospitality?
Thanks, Upra. So GCCs, Global Capability Centers, so they're just innovation and operation hubs for multinational corporations. Think of Google, Microsoft, JP Morgan Chase, Mercedes-Benz, all of them have GCC centers here in India. But here's what's changed. These aren't just back of the office operations anymore. So today's GCCs are driving AI research, product engineering, and digital transformation, strategic work that shapes global business. And the scale, as of 2024-2025, India is hosting around 1,700 GCC centers. That's a 70% jump since 2015. They employ around 2 million professionals and generate $65 billion annually. And GCCs are projected to generate $100 billion by 2030 and grow to 2,500 centers all over India.
That's really impressive. Can you tell us more about where these GCCs are concentrated?
Bengaluru leads by a mile. 875 operational GCCs, which is nearly 30% of India's GCC base. It's generating USD $22 billion and employing around 6 lakh professionals. It's not just a tech hub, it is the GCC capital of the world. Hyderabad, it comes in at second with 355 GCC centers. And the best thing about Hyderabad is they are more sector focused towards life sciences and pharmaceuticals. 9 of the 18 top world pharma companies are based in Hyderabad. You can have companies like Merck, Sanofi, GSK, Johnson & Johnson, Eli Lilly, just to name a few. And pharma GCCs represent 30% of the office leasing activity in Hyderabad. Then we have Chennai with 305 GCC centers. GCC centers in Chennai are more driven towards the automotive and the engineering part. So hence we call Chennai as a Detroit of India. A lot of global companies like Mercedes operate their global engineering centers from Chennai. Then we've got Mumbai, Pune and NCR, which collectively host around 820 plus GCCs. Mumbai is a BFSI capital, and with companies like JP Morgan Chase, Morgan Stanley, UBS. Pune has seen around 150% year-on-year growth in the office leasing activity, driven by companies like Mercedes-Benz, HSBC, John Deere, just to name a few. And NCR is emerging as a fintech and SaaS hub.
Thanks, Sudesh. And I believe this is where the hotel story begins.
Exactly. So here's what people don't understand. So here's what people don't realize, I would say. So GCCs are creating a massive, business hotel demand. You have rotation teams, engineers, compliance engineers, auditors, project managers, traveling between global headquarters and India operations. Pharma companies have QA, QC audits, that last for 4 to 6 weeks. Then you have BFSI firms with their quarterly audits. And then you've got automotive companies which run product launch sprints, which can go up to around 6 to 12 weeks. So this creates two types of demand. So first being business hotels for short stay corporate, which is around 2 to 3 nights, and which has a consistent weekday demand. Second is serviced apartments. So serviced apartments is extended stays, which can go up to 4 to 10 weeks. And here's the opportunity. Weekday occupancies in GCC-based micro markets are 85 to 90%, significantly higher than the city averages of 65 to 70%. Hotels in GCC corridors consistently outperform. Plus, GCCs like good hotels, they are willing to pay premium rates for quality accommodation, proximity to office, and reliable service. Hotels can tie up with local GCCs offering corporate rates, volume contracts, and guaranteed occupancy floors.
That's very fascinating, Siddesh. Thank you for sharing your perspective. Now, I want to bring in Nikhil and Tanmay, who worked on assignments across Bangalore, Hyderabad, and Pune. Nikhil, let's start with you. What's happening in Pune from a hospitality standpoint?
So, first talking about Pune. So, Pune has a huge supply of grade A commercial office, along with having a huge talent pool. From what we have understood that what GCCs look for, especially since they are involved heavily in research, development and product design, Pune is the perfect opportunity for GCCs, especially if we talk about micro markets such as Pimpri, Chinchwad and Chakan, which are like the manufacturing hubs in Pune. Then we have Hinjewadi, which is more of an IT and software hub. Both these micro markets, which is Pimpri Chinchwad, Chakan and Hinjewadi, they are in close proximity, creating the perfect ecosystem for GCCs to enter into Pune. Now, one key factor for these micro markets is these are dense urban centers, which means that if somebody has traveled to Pune for work, they don't want to travel too far in terms of their staying arrangements. It's very crucial that whenever there's new office supply, which supports that office supply, and there's a direct correlation between people getting employed, going to these locations for jobs, and with the business economy comes the demand for hotel room stays as well. If we talk about Bangalore, Bangalore as a market has now saturated in terms of space. So Bangalore is looking for more space. It's looking to expand beyond the existing micro markets such as Whitefield. That's when the ORR or the outer ring road comes in, especially the ORR patch which goes from Whitefield towards Hebal and towards the northern part of the city. That's where a huge amount of office inventory has come up recently, and in fact ORR right now is the largest micro market in terms of the office supply in Bangalore. Bangalore, similar to Pune, has a lot of resources in terms of talent pool as well, and it is also the manufacturing base, especially for aerospace and defense sector. So both these cities present great opportunity for GCCs to come in, and also for hotels to focus on these GCCs and create an ecosystem along with these GCCs.
Thank you, Nikhil. That was very well articulated. Tanmay, can you share your insights on the Hyderabad market?
Thank you so much, Siddesh, for that amazing GCC feedback for us. While talking about Hyderabad, the market research that we did there recently, we saw a lot of GCC development. And when we see offices like this coming up, we see the hotels in and around are able to garner a lot more occupancy and a lot more ARRs. In context, these places like, for example, Gachibowli or High Tech City, they are able to command 70 to 75% occupancy with an amazing ARR of 13 to 15,000 rupees. This ensures and this tells us a picture that any hotel which is built in and around a GCC center is able to garner a lot more premium than what the city is able to garner. And in context, understanding this, how Hyderabad has grown as well, the city is moving towards the airport. So looking into that, the city has moved from Gachibowli to High Tech to Financial District and now moving towards Kokapet. Kokapet is now transforming into the Manhattan of India, and looking at that, the growth of GCCs are also coming up with the same rapid pace.
Excellent insights from both of you. Siddesh, let me come back to you. Beyond the established cities, are there any other emerging opportunities?
Absolutely. The government has recognized the GCC opportunity and is actively creating GCC policy support. Karnataka has launched a GCC policy 2024 to 2029, where they plan to open 1,000 new GCCs by 2029 and create 35 lakh jobs and generate around USD 50 billion in economic output. They are offering rental subsidies, tax incentives, and single window clearances. Telangana is pushing aggressively towards infrastructure development. They are expanding beyond the corridors of high-tech city into new growth zones, as Tanmay mentioned, which is Kokapet. Uttar Pradesh has a draft GCC policy with 100% stamp duty exemption and payroll subsidies to attract over 1,000 new GCCs and create 5 lakh jobs. Maharashtra is developing the GCC policies for Mumbai and Pune, leveraging the current existing infrastructure and the BFSI expertise. And here's what's exciting. Tier 2 cities and Tier 3 cities are being positioned as a next wave. So cities like Coimbatore, Kochi, Visakhapatnam, Jaipur, Bhubaneswar, they are emerging as viable GCC destinations because of lower rental cost compared to Hyderabad, 30 to 40% lower rental cost compared to Hyderabad and Bengaluru, growing talent pools, improve infrastructure with your airports, metro connectivity, ring roads, and tech parks. Industries driving this expansion: IT and software still dominant. Life sciences and pharma fastest growing. Automotive engineering driven by EV transformation, BFSI, and manufacturing driven by Make in India and PLI schemes.
Thank you, Siddesh, for giving us a lot of insight on the GCC. I like to add 2 points. The first point is related with the economics. Last year, you will be surprised to know that India, total export, we have crossed the service export than our goods export. So that shows that how GCC is penetrating in India. And second, 2024 and 25 is a watershed years for India. We have seen the highest level of occupancy of office space in all the major metros, and all this demand is led by either GCC or a flexi office or India facing services.
Rightly said, Vijay sir. And we were just talking about the GCC absorption, but if you consider the total real estate leasing for office space happening, I think India last year absorbed around 80 million square feet. That was the activity in total.
So on thumb rule basis, every 10,000 square foot generate demand for one room. So that's what we, at the time of doing the number crunching, and it's been formula been used from last 1.5 decade, I can say that for sure. And the data talk of its own. The transactions team recently did in High Tech City a hotel lease transaction. It's operational from last 90 days. It has already touched a ADR of 9,000 and occupancy level has crossed 86%. And it's a mid-market hotel. Similarly, in Whitefield, I still remember during COVID time, I was in the process of transacting a hotel, 110 room asset. We received offer of 77 crores. And that was acceptable number to the owner at that time. So we had the term sheet from the buyer, and next morning over the breakfast, the seller, he was sitting with me and he said that what you will do if you are at my place? Will you sell at this number? And to be honest, this is acceptable number to me today. I said the way I see market, I will upgrade this hotel because there was a technical potential was there to upgrade the asset. I will upgrade the asset and I will wait for markets to improve from here. Today, the same transaction in the market of Bangalore, we are closing 150 crores. So thanks to this GCC, the more office demand which has picked up, the ADRs have improved drastically. That hotel which was at less than 3,000 ADR is clocking today 7,000 ADR. So that's what the numbers talk on its own.
Thank you all for sharing these insights on GCCs. The GCC story is a great reminder that hotel demand doesn't just come from tourists. It comes from talent, technology, and global business integration. And that demand is both sticky and repeatable. India's tourism story doesn't end with infrastructure and mobility. It extends into history, culture, and storytelling. Heritage tourism monetizes the past, but also when it's done thoughtfully. Here, the asset itself becomes the experience. Satyajit, can you share with us a few examples of this?
Thank you, Vipra. Heritage tourism is an experience-based high-value segment. India now proudly boasts 44 UNESCO World Heritage Sites and over 3,600 protected monuments and forts. The country's heritage tourism market is forecast to grow from roughly around 32 billion US dollars to 59 billion US dollars in the year of 2033, if I'm not mistaken. Travelers are increasingly drawn to experiences. They are being drawn to staying in palaces, in forts. Basically these are people who want to enjoy the history in life.
That's really fascinating information. Can you please share some examples of this?
Of course. Let us look at the most iconic heritage hotels that we have around our country. Think about the Taj Lake Palace in Udaipur or the Rambagh Palace in Jaipur. Both of them are royal palaces. Now they're converted into luxurious hotels. So here the opportunity is the emerging heritage places. They are the lesser known sites being turned into boutique retreats. What's happening is governments are encouraging public-private partnerships to revive old forts and of course the palaces too. For example, in Uttar Pradesh and in Madhya Pradesh. Okay, let me tell you Uttar Pradesh for example. In Uttar Pradesh, they have launched a policy that converts dozens of historic sites. For example, your Jal Mahal in Barsana, Chunar Fort in Mirzapur. Now these are converted into heritage hotels. In Madhya Pradesh, what's happening is Madhya Pradesh is actually doing something very similar as well. They are opening tenders to transform the 18th century Raja Rani Mahal into luxury lodgings. And so this has been identified, like certain places, these forts have been identified and now they're being converted into these luxurious lodgings. I'll give you another example of Mandu. In Mandu, what's happening is they are actually converting 46 different monuments and they are trying to re-beautify it and create an experience for people to come in and relive it in a way. So that is what is happening at this point.
So Satyajit, what according to you is a successful model that fit project like these?
So these projects, they use an experience center model, combining a heritage property, museum, restaurants, and curated experiences as well. For example, renovated forts might include some trails or an Ayurvedic spa or treatment that is associated in that same fort or palaces. So this is what is happening. Now, investors can directly tap into this trend by developing or partnering with the ASI to re-beautify or restore these forts and these palaces. The rising, okay, I'll tell you the most interesting thing is the rising interest right now. Major hotel chains like Taj, Oberoi, Neemrana, etc., they have been scouting these forts, these palaces, and there's a reason to that. Why? Because recently during the budget allocation, the Ministry of Culture has allocated 3,369 crore rupees just for the beautification of all the 44 recognized World Heritage sites that we have in our country, along with the 3,600 monuments. So this is the right place for them to start thinking and how they can go about with it, and pretty much that, yes.
So how do operators balance preservation of these properties with profits?
Amazing. I was actually looking forward to such a question to come. So the balance works only when the operators, they don't think like developers, and it's when they actually think they are the custodians of the experience itself. That is when, okay, let me tell you this. In heritage tourism, commercial returns don't really come from adding your rooms or modernizing aggressively. They come from authenticity. They come from scarcity. They come from a storytelling narrative. So operators, I'll tell you this, operators usually succeed if they apply three principles. That is, first is adaptive reuse. Here it's the original architecture, you use the same architecture. You do a little bit of plumbing fixing and your ACs and everything, you install it, and you basically use the same fort or palace and you convert it into a hotel. So it's reusing that already existing monument. Your second one is an experience-led monetization. So revenue is not just from room nights. It is a curated dining, guided heritage walks. It could be your cultural performances. So it's the right thought process to how you're going to monetize this. And the most important is a controlled inventory and pricing principles. So most successful heritage hotels are deliberately small. Few rooms might mean higher rates, lower wear and tear, and better term preservation. So the most important thing or the key insight for any investor to take here is preservation is not really a cost. It is actually a product.
Thank you, Satyajit, for sharing those insights. What I really like about this segment is that it reframes heritage as an economic asset and not just a static moment. When done right, conservation doesn't dilute returns, it actually creates scarcity and pricing power. Next topic is one of India's biggest hospitality drivers, which is pilgrimage tourism. Pilgrimage travel is driven by conviction. It is one of the most enduring, resilient, and infrastructure-backed forms of travel in India. What's particularly interesting today is pilgrimage tourism is no longer episodic. It's organized, year-round, and increasingly aligned with modern hospitality expectations. Piyush, help us understand this evolution in reshaping hospitality opportunities within the pilgrimage tourism section.
Thank you very much, Vipra. First of all, since I'm speaking on pilgrimage tourism, I'd like to quote few words from Bhagavad Gita. Shraddha mayo ye purushoto, ye yachada se evasaha. A person is made of faith. Whatever faith he believes in, indeed he becomes that. And today, India is believing to becoming 5 trillion economy soon, and the path goes through tourism, particularly pilgrimage tourism, which contributes 60% of India's domestic tourism. The Ministry of Tourism data reveals that the number of travelers which were engaging in religious tourism rose from 67 crore in year 2022 to a massive 134 crore in 2023, which generated revenue of 1,34,000 crore, which was double than the previous year's 65,000 crore revenue. Cities like Ayodhya, which just had 6 crore visitors in the year 2020, 2024 when the 2025 in the year 2025, it ended with 16 crore plus visitors visiting the temple. Kashi was visited by more than 15 crore people. The Golden Temple generated revenue worth 500 plus crores. Tirumala Devasthanam received donations worth 900 plus crores. Mahakumbh itself generated revenue worth 3 lakh crores. Now that's a very big amount. Now these tourism places have these huge numbers. How is that possible? Because multiple tourism places are developed because of the strong infrastructure, airports that are coming in, the roadways that are improving. And thus, in 2028, we see that this sector will touch almost 5 lakh plus crore. Employment for almost 12 crore people. In last 15 months itself, NOESIS has completed many successful transactions. To name few, we've signed Novotel property in Guruvayur. We've done a Sarovar property in Salasar. We've signed Vivanta in Haridwar. We've done a Holiday Inn in Ujjain. That the story speaks for itself, that these tourism pilgrimage markets are no more seasonal markets. They are developed and established markets.
Piyush, can you please help us understand how pilgrimage tourism is evolving and what that means for hospitality investments?
That's a very interesting question, Vipra. Now, courtesy multiple projects and massive investment from government on infrastructure planning, schemes like Udan, Desh Dekho Yojnas, Prasad, which is specifically a drive for pilgrimage rejuvenation and spiritual augmentation. These drives have contributed to increase in these demands because the ghats are being developed, the roadways are developed, the infrastructures are developed, more airports are made. Thus, people have ease of connectivity and they tend to travel more. For example, Navya Ayodhya Yojana. In that Yojana, the Ayodhya city, 1400 acres of area, a Vedic eco-city will be planned around that. Now this will give a boost of tourism economy to this Ayodhya market. By 2028, we are expecting it to touch 18,000 crore, which is a very big number. Similarly, the Char Dham Yatra covering Badrinath, Kedarnath, Jamnotri and Gangotri, government is infusing almost 12,000 plus crores to creating all-weather connectivity to these markets. Then obviously the traveler who is willing to go there will have ease of travel, he'll travel for sure. For investors, the word is loud and clear. These markets are no more seasonal markets. The message is out there. These markets are performing well, they are stable.
Thank you, Piyush, for beautifully articulating one of India's biggest hospitality drivers. Pilgrimage tourism fits perfectly and captures how tradition and modern infrastructure are intersecting in India. What was once seasonal is now continuous and something that changes investment logic entirely. When we talk about luxury in hospitality, it's easy to default to scale. More rooms, bigger spaces, more amenities. But some of the most compelling luxury experiences today are moving in the opposite direction. They're becoming smaller, quieter, and far more intentional. That shift is where luxury boutique resorts really come into focus. Vikrant, can you please share your experience and elaborate on this topic?
Thank you, Vipra. Whenever we think of luxury travel, we often imagine big hotels, grand lobbies, and endless facilities. But today, luxury has changed. It's no longer about how big a place is, but it's about how it actually makes you feel. That's where luxury boutique resorts come in. Luxury boutique resorts are small, carefully designed properties with fewer rooms or villas. What makes them special isn't size, but the attention to detail. Everything from the design and the food to the service is created to feel personal and thoughtful. In these resorts, luxury is quiet, there are no crowds, just no noise, just space and calm. Guests wake up to nature, not chaos, and staff remember their preferences because they genuinely can. These resorts focus on experiences rather than excess. Instead of offering everything, they do few things, but they do those things extremely right. Whether it is wellness, culture, nature, or heritage. The goal is not to impress, but to help guests truly relax and connect. More people are choosing this kind of travel these days because life today is fast and noisy. Luxury now means slowing down. Privacy, peace, and time have become the new symbols of luxury. Boutique resorts may not be for everyone, and that's okay. But for those who value calm, privacy, and meaningful experiences, they offer something truly special. In short, luxury boutique resorts represent a modern kind of luxury which is quiet, personal, and experience driven.
Can you please elaborate on what luxury boutique resorts are and why are they becoming so popular?
So, luxury boutique resorts are small properties which are often under the range of 50 rooms. Here, the luxury is not loud, it is intentional. The design, location, and service matter more than the size of the hotels. It feels like staying at a beautiful, cozy private home and not a grand hotel. I would say boutique luxury isn't about showing off, but it's about slowing down. So you asked about why are they becoming so popular. In my opinion, people are tired of crowds, which has led to focus shifting towards privacy. There is constant rise in experiential luxury over material luxury these days. So the travelers are now seeking stories out of their trips. Luxury today isn't about how much you pay, but it is rather about how little you have to share your space.
Thank you, Vikrant. That was a great articulation of how luxury today is shifting from scale to sensibility, and why intimacy, intention, and experience are becoming the true makers of premium hospitality. Let's step back for a bit and hold a comparison. Sometimes the clearest insights come with comparison. India and China started from similar hospitality standpoints years ago. However, through the years, their paths have diverged. Nikhil, can you please break this down for us and give us a step-by-step run-through on how the two economies have diverged and changed over the years?
So, India and China are often compared. One is because of the population, and secondly, because they have been, in terms of economy, very central forces, not just in Asia, but for the world. Whenever we talk about economic growth, people look at India and China for reference, because these two countries have been, a very strong reference for growth over the past few years. If we take a look at the past, in the 1970s, both these countries, they started on a similar note. Both of them had a per capita income of about $200. From the 1970s until now, both these countries have grown exponentially, but the journeys that they have taken have been different. If we take a look at China, China focused more on manufacturing of essential goods and electronics, and also the export of their manufactured products. They witnessed something called hyper growth, which was double-digit growth of the GDP in the late 2000s and the early 2010s as well. Just to give you an example, in 2010, China had a GDP growth rate of 10.6%, and in 2011, that was 9.5%. From that particular time in 2011, they have pivoted more towards domestic consumption, innovation, robotics, and AI. The growth has slowed down to single digit, but now it's more of a sustainable long-term growth model that they have adopted. India, on the other hand, took a slightly different approach. India is more of a service-driven economy. Services accounted for 52% of the gross value added, or GVA, in terms of the GDP. And over the past few years, India has been, the fastest growing major economy of the world, and it is looked at as a stable economy in terms of its growth rates as well. Recently, it posted a growth rate of 6.6% in 2024. If we look at how India would be progressing forward, there's a lot of focus on manufacturing, as we covered, with the Make in India campaign, and the focus on developing critical infrastructure in terms of roads, rail, airports, and ports. But apart from this focus on manufacturing, there's also the focus on evolving our service sector as well. As we touched upon the GCCs, and India wants to now move away from back-end offices more towards middle and front-end offices when it comes to service. So India is looking to evolve both in terms of manufacturing and services. If we are to compare how these two countries will go for the next 5-10 years, we need to take a look at the demographic dividend. The median age for China is 40 years right now, while for India it is 29 years. And in terms of demographic dividend, China peaked in 2010, while India will be peaking in 2055. This means that there is a good few years for India to leverage in terms of its young workforce, in terms of both manufacturing and services, and it would be the leading economy in terms of growth going forward as well. Now, when it comes to the hospitality industry, if we are to analyze both the countries, we need to take a look at the per capita income as well. As per World Bank, any country which has a per capita of between $1,100 to $4,400, it's a lower middle income country. And anything above 4,400 is a upper middle income country, and it goes up to a high level income country. Right now, India stands at 2,800 per capita income. In the next 5 years, India is targeting that we reach 4,400 per capita income in terms of US dollars. That would put us from lower middle income to an upper middle income group. And this is going to be crucial, because if we take a look at China as an example and as a reference, China crossed this critical threshold in 2010 when it reached 4,500 per capita income. From 2010 to 2025, the branded room supply in China has almost tripled. And what we are looking at for India as well, that when India reaches this critical milestone, there would be a similar exponential growth when it comes to the hospitality industry. Now, talking more in depth about the hospitality industry, if we take a look at the composition of the hotel rooms in China, upscale and luxury accounted for 21% of the supply in 2010. By 2025, upscale and luxury accounted for 18% of the overall supply. While there is a slight dip in terms of percentage, there has been a huge growth in terms of the overall supply, which means that upscale and luxury has done reasonably well in China. But the big story is the mid-scale hotels, because they have become the backbone of the Chinese hospitality industry. In 2010, mid-scale hotels only accounted for 14% of the overall supply. In 2025, that number has now grown to 34% of the overall supply. And now mid-scale hotels is the largest segment in terms of the room supply. At the same time, the budget hotels in terms of category in China has shrunk. This is due to the premiumization effect that has taken place in China, and a lot of conversions have taken place from budget hotels to mid-scale hotels, and they have truly become the backbone of Chinese hospitality industry. If we take a look at India, the upcoming supply for India as well, we see similar numbers where the majority amount of supply is coming into the mid-scale segment. And that would form as one of our focal points as far as our Indian hospitality industry is concerned. And shortly we would be diving into our Purple Ocean strategy, where we dive deeper into how mid-scale hotels with lower costs and good profitabilities are a good avenue for investors to explore.
So when we look at China's overall economy and we take out just the unbranded hospitality supply, how has that performed over the last few years?
It is interesting that even though the branded room supply has increased substantially, the unbranded room supply has actually reduced, especially from 2021 onwards. And obviously with the volatility that we saw in 2020 and 2021, it underlines the importance of having a strong brand as a partner in hospitality projects. Because what the brands do is they bring expertise in terms of operations, and they have dedicated budget and revenue management teams. What this does is it helps investors and developers navigate economic volatility and risks in a much better manner.
So Nikhil, there is a big delta in terms of branded room numbers between India and China. So according to you, what are the reasons for that?
So if we take a look at the branded room supply in India, right now it is approximately 1.96 lakhs. This is barely 10% of what we see in China. And one of the key reasons is if you take a look at the six major cities in China, which are Beijing, Shanghai, Shenzhen, Guangzhou, Hong Kong, and Macau. These 6 cities account for 1.7 lakhs of branded hotel rooms, which is almost equal to India's entire supply of branded hotel rooms, which also tells us the story that China is not as dependent upon the major urban pockets when it comes to the branded room supply, and they have diversified their hospitality industry very well. And I think one of the things India would need to focus on is extending this hospitality growth beyond just the major urban pockets, more towards tier 3 and tier 4 cities. And another data point which is very interesting is China has very strong local brands. If we take an example of H World Group, it has a branded room supply of about 7 lakhs as of right now. And the BTG Home Inn Group as well, which has a branded room supply of about 4 lakhs right now. Both these Chinese companies individually, they are larger than India's entire branded room supply. So that data set itself tells us a story in terms of the big delta between India and China in terms of the supply. I think right now, if we take a look at the Chinese hospitality industry, there's a slight stagnation when it comes to ARRs. So this is a good cue for India to have a steady growth in terms of hospitality, focus on investing the capital in the right locations, in the right manner, and going forward, the picture for Indian hospitality, it's a very pleasant picture going forward.
Thank you, Nikhil. That information helps put India's opportunity as compared to China into sharp perspective. Across all the themes discussed so far, one idea keeps resurfacing. The most compelling opportunities aren't the ones that are overcrowded. They're the ones that are overlooked. That brings us to our final topic, a topic created by our very own internal team, the Purple Ocean Strategy, which will be explained to you by our own COO, Mr. Vijay Bhandari.
Thank you, Vipra. So let me explain how the Indian hospitality industry is. The Indian hospitality industry right now, we can give a framework which is a purple ocean, where we mix 2 colors together, blue and the red, it forms purple. So Indian hospitality is also like a purple ocean, where there is an immense opportunity, but this immense opportunity is into mid-market and economic segment. I just want to give you some hard fact. Let's start from US, which is the world's largest economy. The total number of rooms what they have is 5.29 million with the GDP of $30 trillion. If you compare what is per capita, how much rooms they have on a population of 100 people, so they today stand at 1.5. If we compare with China has 17.5 million rooms. If you compare with the GDP, it's $19.3 trillion. And if you compare on a 100 per capita, it stands at 1.2. If you go to the third largest economy, which is Germany stands at 1.55 million, and with the GDP of $5 trillion. On Germany, they have 1.8 hotel rooms on 100 per capita. When you look into India, we have only hardly 0.2 million branded hotel rooms. And if you look into the total supply, which is branded and unbranded, we have only 1.2 million rooms which is traded on the OTA. So you can imagine what kind of a purple ocean it is. In India, we have a 1 hotel room on 8,000 people. That's straightforward talk about like there's an immense opportunity in India to build or increase the number of rooms. Today, if you look at the per capita, we are at 2,800. By 2030, we are anticipating by 4,400. We have a world largest population, 1.46 billion. And all this population is very inspiring. And what they are looking for more of a mid-market accommodation than the luxury or upper upscale. Currently, what Indian hospitality industries is there, where half of our or half or more than 60% of our branded inventory is more into luxury and upper upscale segment. We don't have any brand which has open mid-market hotel across India. So there is an immense opportunity to come up with an economy or a mid-market brand to expand in India, pan-India basis.
Vijay sir, how would you recommend a way to strategically expand in this section for an investor?
For investor, I have a multiple framework. Let's take an example of number of districts in India. Today we have 775 districts in India. There are some districts which can take 1 hotel. There are some districts which can take 5 hotels also. So if you go by the district wise itself, we have an immense opportunity to open at least minimum 1,000 mid-market hotels in India. Second framework is that if you look with the connectivity and the kind of infrastructure growth we have, so you can look into the airport. So airport also we have a budget traveler who are traveling with the airlines. There's an immense opportunity. So we have 160 airport and another 20 to 40 airports which is coming up. You can open a hotel there. Okay. So if you miss the airport or if you miss the flight, then I can say you take the bus. There is an immense opportunity to open motels on the highway because currently we are having 3 lakh kilometers of highway which has already been constructed, which include both national and state highway. If you miss the bus, then I will suggest you take the train because there are around 7,500 railway stations right now and government is expanding on the railways front as well. There are another 500 more railway station is coming up in India. If you miss the bus, if you miss the flight, if you miss the train also, then I will recommend you not to miss the port or not to miss the ship because we are heavily spending on the port economy. There are a lot of ports which is coming up and which will be a growth driver for India. So you can open a mid-market hotel at the port. If you miss the bus, if you miss the flight, if you miss the ship also, and if you miss the train, then I suggest you take the Make in India and the logistic route because we are expanding heavily on the industrial side. A lot of new manufacturing facilities coming up to India, a lot of trillions and billions dollar of investment which is coming up. So I suggest you to go and take exposure in Make in India and the logistic hub, which has immense potential for the mid-market hotels.
So Vijay sir, can you give an example of a global brand that is already well established in this sector?
So we'll take a clue from US and China. So in US Motel 6, they already have 1,500 hotels. If you take a clue from the China, there are around, there's a brand called Home Inn. They have around 4 lakh rooms in China in the mid-market or a budget category. So in India, we don't have any brand in the mid-market which has opened and penetrated in such a large scale. So if we follow the strategy of Home Inn and then open mid-market hotels, that will be the right way to see that is the right example to put a global brand perspective.
Thank you.
As we come close to closing this conversation, one thing is clear. Hospitality in India is no longer a story of recovery. It is a story of direction, a direction shaped by connectivity, strengthened by infrastructure, informed by data, and unlocked through disciplined investment. The opportunity isn't about building more hotels. It's about building the right hotels in the right places aligned with the right demand at the right moment in India's growth cycle. This report and podcast is our attempt to map that opportunity not as a prediction, but as a practical guide for investors, developers, and operators. India's hospitality journey is only just beginning. And those who understand where demand is truly forming today will define where value is created tomorrow. Thank you for joining us. And finally, I'd like to offer a special thank you to Iconica Hotels and Resorts for being our venue partner for today.